Hi, my name is Chris, and I'm on the investment team at Bolt. We are a venture capital firm that invests at the intersection of hardware and software. We often write founders their first check and focus on pre-seed, pre-product companies. Over the last 4.5 years, we've invested in about 50 founding teams. We surround them with resources to help them iterate quickly and be capital efficient. This includes prototyping shops in Boston and San Francisco, a full-time engineering staff, and partners with experience shipping millions of units. Today, we're going to talk about early stage funding for hardware startups. We get a lot of questions from founders about the fundraising process, so I wanted to share some thoughts in the hope of making fundraising a little bit easier. There are lots of ways hardware businesses finance themselves. This talk will focus on venture capital, although many of these lessons are applicable when pitching to angel investors as well. But before I jump too deep into funding, I want to take a moment and talk about motivation, and also what hardware means to us and why it's an interesting category today. Most entrepreneurs I talk to didn't start their business with the goal of running a billion-dollar company. Sure, they'd like to make money, but they really want their work to have meaning and purpose. They want to create something new and valued in the world. They want to have status and autonomy. They want to choose the people they get to work with. These are great goals. And believe it or not, VCs have similar aspirations. They also want their work to have meaning and purpose. They also want to solve problems and help create new and valued things in the world. But financially, because VCs are investing other people's money, they have different constraints than the average entrepreneur. To the average entrepreneur, if you own most of your business and sell it for $5 or $50 million, that's a life-changing amount of money. To VCs, that's not. And this isn't out of greed. It's just how venture capital math works. Similar to the movie industry, venture capital is really a hits-driven business, where the majority of returns are driven by outliers. VCs don't primarily invest their own money, they raise financing from what are known as limited partners. These are people who manage large pools of money, like pension funds or university endowments. Limited partners usually allocate a very small part of their portfolio, maybe 5% or so, to risky bets like venture capital, while most of their investments are in safer and more liquid things like stocks and bonds. Because venture capital is both risky and illiquid, limited partners need to be compensated with a higher return. To use a rough rule of thumb, most limited partners need the venture funds they invest in to return at least 3 times their money at the end of 10 years. So, if you're the general partners of venture fund X here, having just raised a $100 million fund, you're trying to return something like $300 million over the next 10 years. To do this, they'll invest in a bunch of companies while reserving part of the fund for follow-on rounds of funding to maintain their ownership as companies grow. Typically, most of these investments won't work out, so the ones that do can't just triple their money. They need their successful companies to return their investment many times over, often 10 times or more. So, if you're taking venture capital, your investors will always push you to either be a really big success or nothing at all. Raising VC puts enormous expectations on your business, and I'd think long and hard about your goals and aspirations as a founder before seeking it. If your goals aren't aligned with your investor, maybe you need to save more money, or look at alternative forms of financing, or pursue a different business idea. So, hardware used to be a dirty word in the VC community. What's changed? Well, most hardware products look something like this. It's a piece of consumer electronics that's prone to commoditization over time. Jawbone was an amazing company. They helped to create entire new product categories, like Bluetooth headsets and speakers, but they got copied by their competition and were commoditized over time. Jawbone filed for bankruptcy this year after raising close to $1 billion. Things like crowdfunding, 3D printers, and systems on a chip are great. They've democratized creation. They've lowered the barriers to entry. They've made it easier than ever to start a hardware business. But the flip side of lower barriers to entry is even more competition. And more competition generally means lower and lower margins over time. You can think about this like the restaurant industry in New York City. It's highly competitive. A few may succeed and achieve economies of scale, but most businesses aren't making any money. This is the story of most hardware companies, partly because of the nature of hardware product life cycles. You sell a product, make a little money, and then get back to work on version 2. These businesses live and die by Christmas, and future sales are highly unpredictable because every 18 months or so, there's an opportunity for a competitor to take away your business. Because of these dynamics, there's a growing recognition in the tech community that to keep competition at bay, you often need to deliver atoms along with bits. Deliver just hardware, and you're likely to get commoditized with lower and lower margins over time. Deliver just software, and you're constrained by the platforms your service is delivered through. But deliver both hardware and software, like Apple, and you can keep consumers inside a garden of gadgets, discouraging intrusion by competitors. Customers are incentivized to stay within your ecosystem and continue purchasing your products in the future. And in the meantime, you can often find recurring revenue opportunities, either through accessories, software sales, or services. The other tech giants have woken up to this. With the acquisition of Nest and Dropcam, and recently part of HTC, Google has been moving in this direction for some time. Amazon got ahead of this curve with Lab 126 and has seen wild success with both its Kindle and Echo product lines. Facebook's purchase of Oculus indicates hardware platform building ambitions of its own. For so-called software companies, hardware is in vogue. So no one cares that your product is connected to the internet, but connectivity can enable new kinds of services that are harder to copy. It can enable updates to your product, it can enable better feedback loops with customers, and crucially, it can enable recurring revenue and moats that keep competition at bay. This is important for investors because the only thing investors like more than high margin revenue is predictable revenue. The longer you can keep consumers engaged with your product, typically the better your business will be. So we've seen a huge growth in hardware investments over the last 5 years, partly for these reasons. And investment today remains strong because a decade after the iPhone, we are again at a crossroads. While the shift to smartphones destroyed entire product categories like PCs, GPS, and digital cameras, it also enabled countless new product categories. The rise of the Internet of Things, smart home, digital health, robotics, and now VR and AR are in large part due to the connectivity and component supply chains created in service of the mobile industry. While we're a long way away from leaving the mobile trend behind, we're at the beginning of the next computing platform shift, where interacting with digital services doesn't always require a PC or a smartphone. From smartwatches and connected light bulbs to intelligent ovens and smart salt shakers, smartphone supply chains have lowered the cost of product development and spurred an explosion of new hardware. To some, this is an internet of shit, but to me, it's democratized creation, where more products get to market and consumers, not VCs, decide which ones succeed. Many of these new products won't reach enough scale to be sustainable businesses. Others will be successful but commoditized by competitors. But a few will succeed. Companies like Ring and Peloton and Formlabs are thriving today, partly and probably would have found it hard or impossible to get off the ground 10 years ago. Just as cheap cloud computing and better developer tools created today's software as a service companies, reduced costs of development and smartphone supply chains are enabling a generation of hardware startups. We really are living in a golden era of product development. That was a lot of background info, but I think it's relevant because if the product you're trying to build doesn't ride these trends, fundraising isn't impossible, but it will be much more difficult for you. You may need to spend more time either saving money or looking at non-traditional sources of funding to get your company off the ground. If that's the case, the rest of this presentation may not be super relevant to you. We're going to talk about fundraising strategy next. Every funding story looks different, and some companies raise money solely on FOMO, but ideally your funding path looks something like this. You build a proof of concept, quit your job, and raise money from friends and family. This gets you to an MVP, so you can start getting feedback from customers, and these early data points allow you to raise a pre-seed round, hire a small team, and finish your product development. Having finished product development, you put together an institutional seed round of a couple $1 million, ship your first manufacturing run, customers love it, your metrics look great, Series A investors are falling over themselves to fund you, you're off to the races. For most companies we talk to, the hardest part about this process is in between seed and Series A. That is, going from having raised a couple $100,000 and shipping your first units to raising the millions of dollars it usually takes to get to market and scale. That's not to say raising angel or seed money isn't hard, but many companies don't look far enough down the road and understand what they're getting themselves into. This transition sucks. And it sucks because you're usually trying to raise a Series A in the middle of manufacturing hell. First production runs are often in the few thousand unit range, so you're likely sourcing components in small quantities, and economies of scale haven't kicked in yet. Because it's your first production run, things like injection mold tooling or factory engineering are amortized over a small number of units, so you're not really making money yet. Also, because you're a young and unknown company, your factory probably hasn't given you great payment terms. You're likely paying 50% up front and 50% on delivery. If you have a contract manufacturer who really believes in you, maybe they've given you net 30-day terms, which means you don't have to pay them until 30 days after they've delivered your units, but that's pretty rare. Also, you're in fundraising hell because you're navigating this transition from pitching what could be to pitching what is. You were pitching the story of potential, but now you've already started shipping, so investors zero in on traction metrics. How much revenue do you have? What are your margins? And since you've only sold a few thousand units, revenue and margin numbers probably aren't great yet. You're still fixing quality issues from the first production run, so there may also not be a good story to tell about Amazon reviews or Net Promoter Score. This is a tough place to be. At this point, you're likely still figuring out customer acquisition. The founders I talk to are often so focused on getting first units out the door that almost all of their seed round has gone towards engineering hires, and not towards hires focused on customer acquisition. So it's hard to get Series A investors excited because you're trying to tell this story of huge potential, but you've already started shipping. And so everybody gravitates towards telling the story of traction, and that traction story probably isn't great yet. When you're raising seed funding, make sure you're thinking far enough down the road and understanding this difficulty ahead of you. So when companies are pitching us, I'm thinking about this valley of death, and I have a couple of questions I'm asking myself. There are the usual ones like, how good is the team? How big and exciting is the market? But I'm also trying to figure out if their story is exciting enough to get them through the hard times. I know the hell they're about to go through, and I'm trying to figure out, is this story enough for them to raise multiple rounds of funding based on its potential alone? Does it give them enough runway? Be very clear about the kind of story you're telling when fundraising, and be careful about trying to tell a story of traction before it's fully baked. Too many founders try and pitch a story of traction too early on into fundraising. I know investing in a company at this stage is going to be risky, likely in ways that neither of us fully appreciate yet. So at the stage that we invest, the pre-seed, we're not looking for companies to say our business has been de-risked. We're looking for them to convince us that the problem is worth solving in the first place, that it's painful enough, that it's valuable enough, and that the team is good enough to solve it. So, in my view, it's a danger to pitch revenue numbers too early on because what seems like a lot of revenue for a founder might make you seem small and uninteresting to an investor managing hundreds of millions of dollars. Other times, early revenue numbers may not yet be indicative of a big business or a scalable customer acquisition strategy. This is why it's a misconception that pre-sales and crowdfunding are a strong signal for early-stage investors. This is true in breakout cases, if you can raise tens of millions of dollars in a pre-sales campaign, but a few $100,000 typically doesn't cut it. Pre-orders are great for helping finance production runs, but they aren't often indicative of a large or interesting market. When most early-stage investors talk about needing more traction, it's either a bullshit way to pass or they're not talking about revenue. They're talking about problem traction, or product development traction, or team traction. They're saying that the story of potential isn't exciting enough yet. Another question we're asking ourselves is, what kind of company are you? We have different mental models for what it takes to be successful in different product categories. To go back to the venture capital is like Hollywood analogy, successful mainstream movies usually fit pretty squarely into a category. Romance comedy, horror. Founders often try and break the mold in too many ways. They're trying to bring a product to market in a new category with a new business model distributed unconventionally. A startup can do one new thing well. If you're a consumer goods company, come in telling stories of revenue potential, something about high margins and brand premiums and your distribution strategy. If you're selling a B2B hardware product, come in telling a story about your monthly recurring revenue growth and customer retention. Tell me about your customer acquisition costs and how long your sales cycle takes. What mental models should I use to think about your business? Who are you like? Who are you similar to? And to be completely honest, the real question going through my mind is whether or not a later stage investor might find this interesting. At Bolt, we lead pre-seed rounds of financing. We'll follow on, but not typically lead a company's future round of funding, so we're trying to figure out if we can spend a year working with the company and help turn it into a fit for later stage investors. Because I'm not just trying to understand the facts, I'm trying to figure out if you're the kind of founder that creates FOMO. Fundraising isn't just about rationally conveying information, it's about creating an emotional connection with your investors as humans. Because your job as CEO is to create this FOMO not just in future investors, but in potential employees and customers and retailers and manufacturers and other business partners. You need to convince an army of people to come along with you on this journey. Investors are just trying to figure out if you're the kind of founder that can do that, if this is the kind of story that compels people to join you. It's not just about the content of your story, it's about the way it's told, too. Okay, so that's it with high-level strategy. Here are some tactics and tips. Even companies that raise money easily have gotten told no more than yes. Recognize that few investors you pitch will convert, and that's okay. Fundraising is often a CEO's full-time job for months at a time. Streak is a great plugin for Gmail that helps you keep track of the funnel. This is a numbers game. In the beginning, your goal is just to find a lead investor who has the conviction to commit and fill at least half of your funding round. This will help corral other investors to participate. In building your funnel, start by searching for investors that have a connection with your product space. This is sometimes super easy to do. Search their posts on Twitter or Medium, see who has prior interest or investments in your product space. Investors with prior experience may not actually be more likely to invest, maybe they're scarred, but you'll spend less time educating them and get to a yes or a no quicker. Most investors ask for pitch decks prior to taking a meeting. Generally, less is more here, as the point of a deck is not to convince someone to give you money. Initially, you're just trying to get a meeting. Leaving out some details is like building a dating profile. Sometimes the more you leave to imagination, the better a prospect can seem. Bring a more thorough deck to any in-person meeting and also prepare an operating plan, detailing upcoming expenses and hires. Raise money when you can, not when you need to. Things that generally make it easier to raise money include an engineering prototype that investors can demo, a valuable team addition, or some major piece of customer traction, like a purchase order with a major retailer. There are many outlier examples of successful companies with these red flags, but venture capital is a game of pattern matching. Some starting conditions indicate greater likelihoods of company failure. Things like if there's too much family in the company may indicate suboptimal hiring practices. Too many MBAs, JDs, and PhDs may indicate either a lack of business instincts or lack of diversity of skill sets. Any one of these things is rarely a deal killer, but too many may make it really hard or impossible for you to raise funding. Investors get pitched so many companies a day, often in different industries, that's just hard to have conviction about product ideas. When they pass, it's often because they don't have strong conviction. They're saying, I don't know, as much as they're saying no. The best way to get over this is with a demo. And if your product isn't something investors can demo, show customers freaking out in a video. Have anecdotes. Have testimonials. Everyone talks about the need for introductions. Plenty of investors these days will invest off of a cold pitch, ourselves included. But intros are about rising to the top of someone's priority list versus working through a deal process. Ideally, this intro is not coming from another investor. Ideally, it's coming from a founder they've worked with for a long time and think highly of. If I, as an investor, am introducing you and I haven't invested, that sets things off on the wrong foot. It's saying, hey, I passed on this company, but do you want to take a look? Raising money outside of New York City, Boston, and the Bay Area is definitely possible, but really hard. The funding gap between the Bay Area and other hardware hubs actually got worse in 2016, not better. Among the ecosystems compared here, the Bay Area took 65% of hardware funding in 2015, but a whopping 75% of it in 2016. Network effects and economies of scale tend to make many technology markets winner take most. This power law phenomenon that drives venture capital returns likely drives hardware community success as well. While there has been a lot of talk about the decline of San Francisco and the rise of the rest, unfortunately the data does not yet support that narrative. This presentation glosses over a ton of things, so I highly recommend these books for further reading. Venture Deals by Brad Feld, 0 to 1 by Peter Thiel, and the Startup Owner's Manual by Steve Blank are all Bibles of the industry. I highly recommend them. And that's it. Below this video, you'll find a spreadsheet of the most active venture funds in hardware. If you have any questions or corrections, please let us know. And if you're raising pre-seed funding and thinking about venture financing, we'd love to have a conversation. Click the link below to upload a pitch. We'll reply back as soon as possible.